So let's talk about how small apartment investors can develop a strategic asset allocation strategy. First, you'll want to assess your investment goals and, your risk tolerance. If your focus is on income, it's usually best to prioritize stable assets like real estate and fixed income. On the other hand, if you're aiming for growth, you might want to allocate more to equities and alternative investments for capital appreciation. So, with a balanced approach, you basically combine growth and income assets to, balance risk and return. Now let's determine your target asset allocations. For example, if you're a moderate risk investor, you might have 40% in equities as your main growth driver, 30% in fixed income for stability, and income generation 20% in real estate to provide steady cash flow and appreciation, and then, 10% in alternative investments for diversification and potentially higher returns. So, let's construct and analyze portfolios. We'll start by applying Mean-Variance Optimization. Basically, you use historical data to estimate expected returns, standard deviations, and correlations of different asset classes. Then, you generate an efficient frontier, which shows the optimal portfolios for various risk levels. Finally, you select the optimal portfolio by choosing one on the efficient frontier that really aligns with your risk tolerance and return expectations. So, let's talk about implementing rebalancing. You'll want to rebalance your portfolio quarterly, semi-annually, or maybe even just once a year to restore your target allocations. And it's a good idea to use rebalancing thresholds like plus or minus 5% to help you figure out when adjustments are actually necessary. Alright, here's an example of using Mean-Variance Optimization to create an efficient frontier. For inputs, let's say you have equities with an expected return of 10% and a standard deviation of 15%. Fixed income comes in with an expected return of 4% and a standard deviation of 5%. Real estate, on the other hand, has an expected return of 7% and a standard deviation of 10%. Now for correlation coefficients, equities and fixed income are at negative 0.2, equities and real estate at 0.3, and fixed income and real estate at 0.1. The output? Well, you get an efficient frontier that might show, for example, a low-risk portfolio with 70% fixed income, 20% real estate, and 10% equities. A moderate risk portfolio could be 50% equities, 30% fixed income, and 20% real estate. And finally, a high-risk portfolio might look like 70% equities, 20% real estate, and 10% fixed income. The key insight here is that the moderate risk portfolio actually maximizes returns for a risk level that's acceptable to the investor. When it comes to strategic asset allocation for small apartment investors, there are some pretty clear benefits. First, you get optimized risk-adjusted returns, which means balancing growth and stability to hit your long-term financial goals. Enhanced diversification is another big plus, since including low correlation assets helps reduce your overall portfolio risk. There's also long-term discipline because this approach sets up a consistent investment strategy that's aligned with your financial objectives. And finally, market adaptability. Periodic adjustments let you respond to changing economic conditions, which is, honestly, pretty important. To sum things up, strategic asset allocation is really essential for small apartment investors who want to build resilient portfolios that match their financial goals and risk tolerance. By applying principles of modern portfolio theory, mean variance optimization, and the capital asset pricing model, investors can put together efficient portfolios that balance risk and return. And, regular rebalancing and sticking to a disciplined strategy help ensure long-term consistency and adaptability, which positions investors for sustainable success.